Good morning. It's Wednesday, the 13th of November, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The Take. A few years ago, while moving homes in central Mumbai, I tried to get my state-owned telecom company MTNL's landline transferred to the new residents. After all, the previous number had been in service for several years, it was known to many people, and had largely worked fine. It took several days of calling and visiting, including by a persistent office boy, to establish that MTNL had no new cables in the area in question. In one call to the telephone exchange, an assistant engineer picked up the phone and helpfully asked me if I was okay with a fibre connection for the internet. Sure, I said, and then the engineer was not to be found. In retrospect, I felt he had picked up the phone accidentally. It finally emerged that there was never any prospect of a new MTNL line in that area, at least to the apartment complex I was moving to. In frustration and some sadness, I surrendered the phone line, which, by the way, is a term that's quite unique to the Indian telephone system. MTNL's travails are not new. The company, which runs telephone operations in Mumbai and Delhi, has been on a death spiral of sorts for more than 2 decades. More than a decade ago, a colleague told me that he once visited a telephone exchange again in Mumbai and was shocked to see that the line to return or surrender the phone was much longer than the one where people were applying for new connections. That actually was my first anecdotal but real warning sign. While the explosive growth of mobile phones in India has obviously edged out the likes of government-owned MTNL and BSNL over the years, particularly in landlines, these companies also lost out in turn to the fibre opportunity for data and voice. And these markets were almost completely captured by companies like Reliance, Jio, that is, Airtel and Tata's. Reports now say that MTN has failed to repay 1,000 crore rupee loan from the Bank of India, which in turn has affected its second quarter results thanks to a 200 crore provision that it's taken now, which is the Bank of India has taken that provision. Now, it's highly unlikely that this money will ever materialize unless, of course, MTNL is liquidated or assets sold to repay its debts. MTNL's total debt, according to reports that I saw, was around 32,000 crore rupees, including about 7,800 crore owed to various banks and financial institutions. Losses are over 3,000 crore rupees. And the current revenue run rate, as I could compute, seems to be about 800 crore rupees a year, and that too on a slowing trot. Now, MTNL is a listed company, and quite likely its best asset is prime real estate, already being put to good use by leasing out various floors in their buildings to mostly government organizations from what I've seen. Air India's sale to Tata's, despite it being done at a much delayed stage when the airline was on life support, was a good step and demonstration of the government's intent to not be in the business of doing business, particularly consumer-facing ventures like airlines. The last few years have seen several public sector enterprises do well, both in terms of balance sheets and in the stock markets. Now, despite those successes, failures like MTNL stand out like sore thumbs. A private company which fails to repay 1,000 crore rupee loan and in a similar financial condition would have been visited by multiple tax and enforcement agencies by now. It would appear, therefore, that because it's government-owned, a company like MTNL does get a pass. Quite possibly, the government and the Department of Telecom, under whose jurisdiction this falls, has been attempting various methods to resuscitate MTNL, but clearly those efforts have been in vain. And this also raises the issue of who is accountable for rising losses, falling revenue, and increasing interest burden of unpaid loans, and why there is no deadline or a sunset date. Quite likely, no employee or official of the company is under any real pressure, and possibly they could do little even if there was. Now, this, of course, is the case in any state-owned organization where responsibility is diffused at best, particularly when the stakes are down. So the government has made it amply clear, in actions if not in words, that it wants to be in the business of doing business. Debating this point actually might be futile now. But the government is accountable for taxpayer money, propping up lifeless enterprises who have no role, present or future, to play in our lives. There must be immediate efforts to liquidate the company and dispose of the assets and return money to shareholders, which of course includes the government itself. Taxpayers have a right to hold the government accountable for how our taxes are used in state-owned and run organizations, even as they take their last and dying breaths. And that brings us to our top stories and themes for the day. The stock markets flounder once again. Inflation hits a 14-month high of 6.2%. Wall Street balances off record highs once again. Oil prices fall on lower demand expectations. And Hyundai's results come a cropper.
This is the Core Report with Govindraj Ethiraj.
The markets are adrift. Well, if Wall Street is sneezing, India is not catching the flu. Wall Street continues to ride the Trump wave to record highs even as the Indian markets struggle to hold on to gains. The markets are now following a familiar seesaw patterns of ups, and then down again with some variations, of course, which is essentially markets going up and then investors coming in to sell. So the markets fell for the fourth day now. That's on Monday. The Sensex and Nifty were down. The Sensex was at 78,675, down 821 points, once again seesawing in a 1,300 point range. The NSE Nifty 50 was down 257 points at 23,883. Some 46 of the Nifty 50 constituent stocks ended in the red, pulled down by Britannia, Bharat Electronics, NTPC, Asian Paints, and HDFC Bank, with losses extending up to 7.3% according to Business Standard. The broader markets were down too, with the Nifty Small Cap 100 and Nifty Mid Cap 100 falling 1.28% and 1.07%, or just over 1%. All of this obviously indicates that the bearish undertone is more market-wide, unlike before when small caps may have held out better when large caps are falling. Wall Street on a roll. While the Indian markets have been struggling, the Dow Jones Industrial Average has now risen more than 300 points on Monday to close at a record high of over 44,000 for the first time. Both the S&P 500 and the Nasdaq Composite also closed at fresh records. Though on Tuesday open markets, that's Wall Street, was a little more subdued as they took a pause. CNBC reported Morgan Stanley's wealth management chief investment officer saying that the Republicans' decisive win has ignited animal spirits despite already lofty expectations. Rather than viewing developments as a fundamental shift towards the reflationary no-landing scenario, we see sentiment and liquidity-driven positioning for what it is, and we're maintaining our balanced stance, said the Morgan Stanley strategist. Stocks like JP Morgan Chase and Goldman Sachs were up between 1 and 2%, powering the Dow higher. Bank of America and Citigroup shares have both closed up about 2%. Now, you may recall that we've mentioned how financial stocks in the United States and on Wall Street are doing particularly well in recent months, almost alongside the tech stocks. Now, there is a general expectation that Trump as president would lead to more lax regulation in the financial sector. How that exactly quantifies or could translate to more profits or profitability is not clear to me right now. Tesla also continues to rise, this time by 9%, still riding on its CEO's proximity to the Trump administration and expectation, presumably, of some goodies. Large tech stocks lost out on Monday, though. Oil slips down. Oil prices are now holding at this month's low following a fall this week. The reasons continue to be weaker demand in China, a strong US dollar, and lingering concerns that the market might see more production than it needs. A strong US dollar, by the way, means that countries, including India, have to pay more per barrel of oil we import. It would, of course, be interesting to see how the United States, already the world's largest oil producer, would view the oil market given just elected President Donald Trump's promise to drill, baby, drill. That's his term. Higher production from the United States, if that happens, could send prices much lower than what they are, which I'm not sure is very remunerative for all the oil companies. It's also not clear to me if those oil corporations want to drill for more oil at this point beyond what they are, even if they have the freedom to do more. Brent crude is now around $72 a barrel, and Bloomberg reported that traders continue to track tensions in the Middle East, the prospects of a second Trump presidency, and the Organization of Petroleum Exporting Countries Plus decision on output. The outlook remains weak, with global supply expected to outpace demand next year, said Bloomberg. Gold prices are falling. Gold prices are still falling, and now at their lowest level in nearly 2 months on Tuesday. Spot gold slipped to about $2,594 per ounce after hitting its lowest since September 20th at about $2,590. Reuters reported, quoting analysts saying that the dollar strength is weighing heavily on gold. They also said that, interestingly, the relationship seems to have dissipated for much of the year, but now it's back in force ever since the election. The dollar index has risen to a 4-month high, making bullion more expensive. So the dollar is expected to benefit from some of the Republican President-elect Donald Trump's policies that will keep or likely keep US interest rates relatively higher for longer, and that obviously is an environment negative for non-yielding gold. The other factor, as Reuters points out, is that markets like the United States have done very well in recent times, and I guess right up to yesterday actually, and this means that money is likely to go more into equities and such assets rather than gold, or move from gold to equities. inflation at a fresh high. Inflation levels have shot up again, rising to 6.21% from 5.49% in September. Food inflation has risen to almost 11%. That's at 10.8% from 9.2% in the previous month. Now, this was, of course, on the cards ever since vegetable and food prices started shooting up, as we discussed on the core report just a few days ago. Meanwhile, the index of industrial production growth rate for the month of September was 3.1%, which was marginally lower than August 2024. These figures come out simultaneously. A report by stock brokerage MK Global says that CPI inflation accelerated much more than expected in October to 6.2%, with core hitting the high of 3.84, which is a 10-month high. The uptick is led by rising vegetable prices, which are perishable, edible oils and wheat, while the rise in gold prices is also reflected in the personal care category in the index. Edible oil prices, by the way, have shot up after the government imposed a higher import duty to protect domestic farmers. Most economists are now, of course, predicting that the next month's inflation will be lower to about 5.4% because vegetable prices, which usually fluctuate quite wildly, particularly tomatoes, among others, are likely to come down. The thing to note is that overall inflation for the year and upcoming quarter is higher than what has been projected a few quarters ago. And thanks to high food and vegetable prices, high inflation is now directly affecting monthly food budgets across homes in India, as it has been for some time. This also reduces, as it appears now, the prospect of a rate cut by the Reserve Bank. Remember, most major central banks, including the Federal Reserve, European Union, and the United Kingdom, have been cutting rates this year. I'm now joined by Vivek Kumar, economist at QuantEco Research. Vivek, thank you so much for joining me. So, you've put out a report on the latest CPI or consumer price inflation numbers, which have hit a 14-month high of 6.2%. And you've also said that it's darkest before the dawn. Now, before I come to the outlook, which is the dawn, tell us about what the trend line is looking like, because this inflation number is also driven by a 42% rise in vegetable prices, which I think is a 5-year high.
Correct. You've actually hit the pain points pretty clearly. The last 2 or 3 months, this pain of food inflation, which has been there continuously in the system for the last 2 or 3 months, has probably now reached its peak. The reason why we are saying it's reached its peak is because of the fact that the anticipation of khadi, which typically happens around late October and beginning of November, that khadi produce starts coming on board. That's number one. And we all know that Kharif was reasonably healthy when the sowing data was confirmed. That's one comforting part. The second comforting part is that Rabi sowing has begun on a promising note. There is a likelihood of a La Nina developing later on in the year, which basically means that winter rainfall is going to be more or less on the surplus side once again. And reservoir levels are pretty much healthy, so which again bodes well for Rabi sowing. So putting two and two together, if let's say one has to discard or ignore all the pain points that we have suffered in the last 3 months and start looking forward, then one has reasons to be slightly optimistic about one, the usual impact of Kharif and Rabi starting to depress food prices, and two, the fact that winter seasonality typically begins or kicks in from November and December onward. That should also start to have its moderating influence. So we are possibly at the peak. That is what we infer from the recent shock. So having said that, last 2 months, we would acknowledge that we were surprised on the higher side with the actual peak of inflation data. And the surprise in data has been predominantly on account of food prices and within the food basket as well. Govind, it's not that the entire food basket is the culprit. It's just 2 or 3 key items within the food basket which are the culprit in the current episode.
Right. So, what's the trend line looking like then, Vivek? For example, if I, as a consumer, I'm paying, let's say, in Mumbai, 60 rupees per kilo of onion and 25 rupees a kilo of tomato. I mean, I have to pay these prices when I buy produce. So, how does this even out over a year, for example, or at least this year, let's say 2024?
So, Q3 for us, which is the October-December quarter, has begun on not a very good note. Even if we anticipate prices to come down sequentially going forward, the average for the quarter would still be upwards of 5%. Possibly it would be in the range of closer to 5.5%. the actual relief on a quarterly basis would only come about in the final quarter of the financial year, where inflation could actually fall below 5%. So the reason why we are saying is because we anticipate the food price shock to be of a short duration. So short duration is typically associated with anything of 2 to 4 months. We've already suffered, and all the reasons that we talked about with respect to why we anticipate food price inflation to come up, there is optimism. In fact, there is a reasonable chance of headline inflation coming below 5% level in the final quarter of 24-25. For the year as a whole, I think the average number would still be somewhere close to 4.7% with a minor upside.
So this is a question I've been asking elsewhere to Vivek. So when you look at it, let's say over a year or more, do we have a sense about which way vegetable prices can go? For example, we know that there are fluctuations. We know that those fluctuations are somewhat unpredictable. And to that extent, we don't know when prices will suddenly shoot up and then shoot down as well or come down as well. So in which case, how do we look ahead and try and project if so?
So projecting vegetable prices within CPI would be the task that the most ambitious person on the street would probably undertake. So for us, having a shot at CPI itself is laced with a lot of adventurism, and we take that with a pinch of salt. So it's easier to forecast CPI inflation because positive errors on one tend to offset the negative errors that we make while forecasting on the other. Whereas vegetable prices within food is extremely volatile. It can be in triple digits in 1 month. It can be in negative territory within a span of 2 quarters. So that's the kind of volatility that one faces. For example, you said vegetable inflation, it's 42%. This number was 6.8% just 3 months back. So that's the kind of volatility that I'm talking about. And within vegetables, if you look at the highly perishable items, for example, the OTP inflation that we typically refer to, which is the onion, tomato, and potato inflation, they are much more volatile than the vegetable basket as such. They can easily run into triple digits. So from a retail consumer point of view, I think this kind of volatility in some of the highly perishable vegetable items or food items is bound to continue. And to a large extent, Govind, if I can recall, especially in the last 3, 4, 5 years, the volatility has risen. Possibly it somewhere reflects the impact of climate change, which is a global phenomenon, and which is something that we've also been witnessing. So on the headline level, we often see monsoon ticking the checkbox pretty well, but there are wide variations within that headline being normal. Last year, also last 2 or 3 years, the overall rainfall was pretty good, but there were wide variations. Even that is something which we saw even this financial year. So this, to me, is a reflection of climate change. Especially this year, we moved, or in fact, the pendulum swung from an extreme heat wave in the summer months to a situation where monsoon was highly deficient in the beginning and then followed the latter half of the monsoon season was extremely high degree of rainfall. So the volatility is huge in terms of climate weather patterns, and that is getting reflected in your perishable items. To some extent, you can control the non-perishable food items or probably the items which have a longer shelf life, like cereals and pulses. But the highly perishable ones, especially fruits and vegetables, would continue to bear the brunt.
Vivek, thank you so much for joining me.
Thank you so much, Govind.
Hyundai's results. There is a moral of sorts in the story here. Hyundai Motor, the country's second largest car maker, posted a 16% fall in the first quarterly profit after its IPO public listing last month. It reported a net income of about 1,340 crore rupees for the quarter ended September 30th, according to a filing on Tuesday reported by Reuters. Revenue slipped about 8% to about 16,880 crores and costs were down about 8%. The company said that the decline in profit was mainly due to weak market sentiments and geopolitical factors, though it expects a sustained demand momentum in the mid to long term. Hyundai earlier made news for its somewhat tepid response to the $3.3 billion IPO last month, which was largely pushed through by institutional investors. It's highly likely, by the way, that Swiggy, a food delivery company who also benefited from institutional support in its IPO fundraise in the last few days, will also list weak or down in coming days. So Hyundai's tepid earnings is the latest show of the broader consumption slump in India that's hurt sales of everything from soaps to instant noodles and paint, Reuters said. And paint is something that we did discuss yesterday with Asian Paints results. Meanwhile, Hyundai will roll out an electric version of its Creta in the coming months and sees it as a game changer in the EV market, the company said. And the moral of the story, well, there could be many, including one, to not sell your shares at such high prices when you know tough times are not far ahead. So the Hyundai stock has now fallen about 9% since debut, and Reuters reports it's dropped faster than the benchmark NSE Nifty, which is down about 3.3% for the same period. What does Warren Buffett know? Warren Buffett, the legendary investor, is now sitting on some $325 billion of cash and equivalents, mostly in treasury bills, as you know. Now, this is causing concern on Wall Street and presumably elsewhere, with investors wondering if there's something that Buffett knows that they don't, which is about the markets, where they're going, and are they overvalued. The Wall Street Journal asked yesterday that when the world's most followed investor doesn't feel comfortable investing, should the rest of us be worried? Warren Buffett has often said that his favorite holding period for a stock is forever. And the Wall Street Journal says that Buffett and his late partner Charlie Munger didn't outperform the stock market 140-fold by being market timers. Probably Charlie Munger's most famous quote in his first rule of compounding, never interrupted unnecessarily. Investors who follow Berkshire closely, that's the company that Warren Buffett runs, and hope for a bit of its magic to rub off on their portfolios, pay very close attention to what it is buying and selling, but much less to when. Buffett has apparently turned cautious before, famously shutting his extremely successful partnership in 1969 when he said markets were too frothy, and also building up substantial cash in the years leading up to the global financial crisis, which he of course deployed opportunistically. Stock values being stretched doesn't mean they are on a precipice of a crash or even a bear market, according to Wall Street Journal, and also quotes Goldman Sachs strategist David Kostin saying, or rather predicting recently, that the S&P 500's return over the next decade would average only about 3% a year, less than a third of the post-war pace. With treasury bills now yielding more than the prospective return on stocks, it might seem that Buffett has taken as many chips off the table as possible, since there is no upside seen in risky stocks. But he's on record saying that he'd love to spend it. What we'd really like to do is buy great businesses, he said at Berkshire's 2023 annual meeting. If we could buy a company for $50 or $75 or $100 billion, we would do it. Berkshire is now worth $1 trillion. So it would take a large deal or a deal of that size to move the needle. So all of this, could it mean that Buffett sees value in keeping dry powder ahead of the next crisis or general froth in the market? Asks the Wall Street Journal, and answering that he isn't saying, and that's something that investors here in India could also take away. Remember, we've been documenting how some mutual funds are increasing their cash levels, not substantially and not so many, but that's something to note. Direct taxes are up. The government's net direct tax collection grew almost 15% year-on-year to about $143 billion or 12 trillion rupees after tax refunds during the period. That's between April 1st and November 10th, according to the Central Board of Direct Taxes on Monday. Direct taxes, which include corporate and personal tax, that's on a gross basis, grew about 21%. Gross, that is, including refunds. Interestingly, securities transaction tax contributed to about 36,000 crores so far this year, 90% more than the 19,000 crores collected in the same period a year ago. So you can see that the level of stock trading has gone up quite sharply, and presumably the value as well. So far, the tax department has collected 55% of its direct tax collection for the full financial year. And a report in Mint says that a growing tax base has helped. All of this backed by extensive data collection, wide use of taxes deducted or collected at source, pre-filling of tax return forms, and restrictions on use of cash and promotion of digital payments. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.